There will be no escaping what's coming. I'm your host, Steve Van Metre, and thanks for joining me today. And if you thought things couldn't get worse, just wait. This country is going to take the world down with it. So did Wall Street Journal, where we picked today's story up, as China's exports drop sharply as global economy slows. For China, the world's second largest economy, the sharp pullback in demand for its goods abroad removes a key prop for growth at a time when the economy is pressured by the government's zero-tolerance approach to COVID-19 and severe real estate slump. And while there's hope for Chinese policymakers that they can create enough internal growth to sustain the country, they can't. They're heavily reliant on everyone else. And as the world's economy slows down, well, China is a proxy of what is to come. With growth slowing in the U.S., Europe, and China, economists are downbeat about the global economy's prospects this year and next. The International Monetary Fund warned that last month that the worst is yet to come, saying it expects global gross domestic product to expand 3.2% this year before slowing down to 2.7% next year, which I'll say is optimistic when you start looking at the broad data that's coming in, saying the world is headed to a major slowdown in 2023. The China export slowdown is a worrying sign for global growth, and finally, someone who gets it, as exports from China declined 0.3% last month compared with a year earlier, as China's General Admission of Customs said on Monday, the weakest pace for growth since May of 2020. When trade was hobbled by countries' early efforts to contain a worsening global pandemic, that it was well below the expectations of economists polled by the Wall Street Journal, who had expected exports to increase 4% year over year. And Monday's data showed exports to the U.S. fell 13% on the year in October, the third month decline, while sales to the European Union fell 9%. And here becomes the key point of today's story. When demand from the U.S. is falling, that is key because U.S. is the largest consuming nation. Of course, China is the world's largest exporting nation. So if demand from the U.S. is slowing, what it's telling us is the U.S. economy is slowing and China is seeing it first. And this is exactly what we should see, is the manufacturing base of the world, which is in Asia, should see the first slowdown, indicating that what is coming to the rest of the world is just starting here in China. The data shows big falls in exports of products, including home appliances, medical supplies, and weakening growth in exports of mobile phones and automobiles. So it's broad-based. It's not a narrow slowdown. And other bellwether exporters in Asia, such as South Korea and Taiwan, have also reported faltering overseas sales, pointing to, just as I said, a broad slowdown in trade as a global economy loses momentum. And as we talk about inflation, what we'll see here shortly is that slowdown coming out of Asia is going to lead to a sharp slowdown in consumer price growth in the U.S. at a time when the Fed is still in panic mode about raising rates. And what we're going to find out is they're going to be on the wrong side of this as consumer price growth crashes and they're still in tightening mode. China producer prices turned negative in a warning sign for the global economy as the hits keep on coming. Chinese producer prices fell 1.3% in October compared with a year earlier, according to the country's National Bureau of Statistics. This country's first year-over-year decline in producer price inflation since December 2020. And again, this is now a very key point here, is this is the first negative year-over-year change in producer prices. How does that translate here in the U.S.? Well, it's simple. What's producer prices coming into the factory in China lead to lower prices coming out of the factory, and those goods are exported to the U.S. And as you're about to see, here we see import prices in red against consumer prices in the U.S. in blue. And what do we see on a year-over-year rate of change? You notice a nice relationship with the two of them, suggesting that as import prices fall, and we know that's to come, because what did they say? December 2020 was the last time this was negative, and you can see here that was when inflation in the U.S. was just above zero, telling us everything we need to know, and that is inflation is coming down in a big way. It's going to happen with a couple months of lag, and you'll watch going into next year, the Fed is going to have a massive change in pace as they look to cut. Taken together, the weakness in the world's second largest economy points to a global economy that's losing steam, as central banks led by the Federal Reserve, who remain pretty clueless, ratchet up interest rates that contain rocketing inflation, and yet they can't see in this data that inflation is going to come down regardless of what they do with rates at this point. So whether they keep increasing or they pause or cut, it's baked into the cake, and you can see it. It's all because of this relationship between China's pricing and what affects U.S. consumer prices. The drop in producer price inflation in China comes alongside a month-long slide in shipping rates, as we covered recently, which should together offer a degree of relief on goods price inflation for consumers in the U.S. and Europe, which could push inflation back down to zero. And China's economy takes a deeper hit as retail sales turn negative, again a sign that this country cannot get things turned around. And new data released Tuesday showed economic activity cooling across the board in October. Retail sales contracted unexpectedly for the first time in 5 months. This is key. Contracted unexpectedly for the first time in 5 months as factory output growth slowed and a pullback in real estate investment accelerated. And we can really connect the dots on this, because if demands from countries like the US and Europe lead to less production in China, which we're seeing here, well, that means you have less jobs, and less jobs in China means less consumption, and retail sales are likely to fall because people can't afford as much, because they don't have as much. And all of a sudden you can really see how this is starting to spiral out of control, and there only is one hope that the markets will have, and that is central banks will have a change of mind much sooner than later. The fresh signs of slowing growth in China will add to fears that the worst, again, is yet to come for the global economy, with many economists predicting a recession in the U.S. over the next 12 months. In reality, we are going to see that in 2023. And more evidence that China's economy is slowing says that we see here in the official monthly PMIs missing forecasts and moving into contraction. Both the official Manufacturing Purchasing Managers Index and the non-manufacturing gauge, which measures construction and services activity, fell in the month to 49.2 and 48.7, missing economists' expectation. A reading below 50 indicates a contraction in activity, and what this tells us is this is eventually coming to America. When we get the official data, what we should start to see either later this month or actually will be now in the December data or into January, what we should validate is the U.S. factory and services sector is contracting, and it all started right here in China. And that's why it's so important to keep an eye on the world's largest exporter, because what happens there will eventually happen everywhere else. PMI sub-indices were weak across the board as new orders for manufacturing fell. Again, that's a key point. New orders, input and output prices rose, and job losses appeared to mount, which makes sense given the retail sales data. Indices measuring manufacturing and non-manufacturing employment both slid. A sub-gauge measuring delivery times declined, a sign of disruption to manufacturing logistics. And of course, this then comes into the banks and back to Wall Street as global banks are quietly cutting China jobs as big bank fizzles. China's financial opening that kicked off 3 years ago was supposed to be the biggest banking play of a lifetime. It's now at risk of floundering as a slump in deals and growing political tension forced global banks to recalibrate their plans to conquer the $56 trillion market. And this all then turns back to the China assets. As China's safest assets get ditched, as stocks go on a bull run. So I want to point out here what's going on. Is so far you see China slowing down. You're seeing Wall Street pull out because they're starting to say, hey, all these deals, all this money we could have made there is not going to happen. And what do you think the markets are going to start to price in? And you guessed it, they're going to see that the China Central Bank is going to start easing. That's the prediction that the government is going to do stimulus programs, because once they realize that this thing is spiraling out of control, they're going to try to stop it. But as we know throughout history, it's always too late, because monetary policy hits the economy with a lag, and here you'll see. A growing optimism about the world's #2 economy is altering the narrative on Chinese assets, forcing traders to recalibrate their bets on nation stocks, bonds, and currency. Almost overnight, sovereign debt has lost its appeal as expectations for aggressive easing wane. and the Chinese equities rally amid bullish calls from likes of B of A. Again, this whole notion that, hey, fiscal stimulus, monetary stimulus, in the short run, that can be absolutely bullish for the market. But what happens, and again, what we're seeing here is the traders are saying, look, this is really bullish. They can turn it around. What I want to suggest to you is it's way too late. And even if they attempt to, while there could be a short-term boost in stock prices, the reality is we are headed to recession, and there's nothing the central banks can do at this point to turn China around. China bonds may have priced in too much pessimism over economic growth, and a steep decline in yields is reflecting a turnaround in sentiment as the easing bets on PBOC rate cut, there we go, or rate cut built previously have been harder to materialize, triggering the big retreat in bonds. So you'll note here is they haven't completely bought into the fact that the central banks are going to cut, but they're jumping onto risk assets. In reality, what's going to happen is the central banks are going to cut. They're going to be forced into it, because what I'm about to show you is there's still problems in the Chinese banking system. And of course, we know when liquidity problems happen, central banks, they cut. If China asks banks to report on liquidity after bond slump, as short-term debt falls as investors shift towards stocks, leaving people to wonder, can the system handle it? As Chinese regulators ask banks to report on their ability to meet short-term obligations after a rapid sell-off in bonds triggered a flood of investor withdrawals from fixed income products. But get this, several banks have issued public statements to reassure investors that the turmoil will be contained, while the People's Bank of China nearly doubled the size of its financial system cash injections through open market operations. Bingo, there you go. So that's the first step toward what will be cutting. And of course, we know the central banks are going to cut because we know inflation is going to come down. You don't get rising inflation when unemployment starts to rise, when job losses start to mount and demand falls off the cliff. So too does prices. Let's keep it going here. One person familiar with the matter, whose regulatory oversight said liquidity conditions are likely to stabilize in the next few days, but if they don't, well, we know the PBOC will be back with more and more and more until the data shows that they have to cut, even if there is inflation. And we've seen the Fed do the same thing in the past, because where China goes, the rest of the world follows. So if you don't think things are going to get any worse, we'll keep an eye on China, because they're telling us they are. And with that, I'm Steve Van Meter. Thanks for watching. Thanks for being fans. Bye now.